Good evening, everybody. Sorry once again for the technical problems. Each night is an adventure with Omnovia. But we got the honor of having Peter Schultz speaking with us tonight, and he's going to go through a session showing us how to effectively use credit spreads. So I'm going to let him go through his background and let him get started. Peter, thank you very much for doing a presentation for the Candlestick Forum.
Well,
also one more thing. Yep. One more thing. Let's hold off on questions until he's done, and then he'll take all the questions that you can muster up. All right. Sorry to interrupt you, Peter. Go ahead.
All righty. Hey, listen, thank you for being patient and sticking around. I'm really excited to present for Steve's group here. The name of this webinar is How to Trade Credit Spreads for Extraordinary Monthly Returns. If you know about credit spreads already, if you've traded them in the past, there's actually going to be some things that you can learn here that you might find pretty darn interesting. If you don't know what credit spreads are, if you have no idea what they are, I think this is going to be really, really exciting for you. I've done all kinds of trading for many years. I've been trading stocks for over 30 years. I've been trading options for, going on 15 years now. And trading is, boy, I'll tell you, it can be challenging. And what's really, really cool is when you find something that actually really gives you an edge in the market and a real mathematical edge that you can see and feel and realize in your trading account. So that's what we're going to talk about in this presentation. It's going to be fairly fast-paced. You can take notes if you like. There's going to be some good information. And I understand Stephen's also going to be offering a recording of the event. So if you don't want to take notes, if you just want to hang on and go along for the ride, you can do that too. So the subheading here is Discovering the Winning Secret for Stacking the Deck on Every Trade You Make. That's what we're going to do. My name is Peter Schultz. I'm the president of Cash Flow Heaven Publishing. And I'm the chief strategist. I actually write our trading letter for The Winning Secret. So we publish 3 different subscription services. They're all kind of designed to help you bring in more cash flow every month. I think that's what people really need, especially going forward. We would all like to have a really nice growing income that we could depend on, and this is just a tremendous way to do it. So I've had a lot of experience trading. I've spoken around the country. I've written several books, short reports. I've been on TV, radio, lots of exposure. And I can just tell you I've had a lot of experience trading and a lot of experience with this particular strategy. So let's just move forward really quickly here. And the strategy is completely different than the way everyone else trades. That's one of the really kind of cool things about this. Most people buy a stock or an option looking for a big score or at least a really, really, big move. And I've, done a lot of short-term trading, done swing trading, done breakout trading, done a lot of things. That's really appealing. That's really fun. Typically, their research tells them a big move is coming and they want to take advantage of it. So if you've traded at all, that's probably something you're really familiar with, really experienced with. We're going to jump on the other side of that equation with this strategy, and I'll tell you why. When you're speculatively trading, when you're going for short-term moves, whether with stocks or with some leverage, with options, there's just one problem with that approach. Sometimes the market doesn't do what you want it to, and we've got our happy couple here looking at their computer thinking that they were going to make a fortune day trading. And you know what? I don't know if you've ever had teenagers. I don't know if there's any parents out there, but sometimes the stock market is like teenagers. They just don't do what you want them to do. They zig when they should be zagging. And, you can get all the technical analysis in the world. You can line up all your fundamental analysis. You can do all kinds of stuff to try and ensure that you're going to be right. And, a strange thing happens between, on your way to the bank to deposit all your money. The truth is, in spite of our best efforts to predict short-term moves, the stock market is often erratic. And it reverses when we least expect it to. So, of course, speculative trading can be fun and exciting, but unfortunately you have to be very accurate very consistently to make money. And you may have experienced this with your own trading. I know I have. So wouldn't it be nice to trade the majority of your money Set aside 5 or 10% for the speculative stuff. Wouldn't it be nice to trade the majority of your money using a strategy that gives you a built-in advantage on every trade you make? So, what are credit spreads, and why do they work so well? Credit spreads are an options strategy. And like all option strategies, they're based on a formula. Now, the original formula for options is the Black-Scholes model, and that was conceived back in the early 70s. And it is 1973 to be exact, and it's what made formalized regulated options possible. That's when the CBOE formed, was back in 1973, actually relatively recently. This pricing model was so revolutionary that the gentleman that created it, there were actually three individuals involved, and they received the Nobel Prize in 1997 for this formula. The formula is pretty amazing. I've tried to beat this thing with all kinds of clever option strategies, and the formula prices options fairly efficiently, and it does it even better today than it did. They've made some improvements, some modifications on this formula over the years, but options are priced on a formula. I want that to kind of stick in your mind for a minute, because it relates to what we're going to be doing here. And fortunately, you don't need to know this math. You don't need to be able to memorize this formula or be able to work it on a chalkboard for it to make you a lot of money. Just like you don't need to know the internal workings of the internal combustion engine to drive your car to the bank. So, one of the great things about this formula is you can instantly see your probability of winning. And with credit spreads, our probability of winning is typically the way we do it, between 80 and 90% on every trade we make. This is why I love this strategy so much. If you put on credit spreads correctly, and you did a Rip Van Winkle, or if you slip on a bar of soap in the shower and hit your head and you wake up a month later, you're going to make money on 80 to 90% of your trades. That's kind of the way it plays out in the real world, and it's rather amazing, especially if you're used to more of a speculative win-loss ratio. So you have this built-in expectation of winning, and that's why I love it so much. It takes a tremendous amount of pressure away from you with your trades. So what is your reward, and what is the potential of learning this strategy? If we're going to learn something new, we need a reward and we need a potential. We need a big reward for paying attention and learning something that we haven't done before. If you learn how to bring in enough monthly income that is not based on your labor, you will be financially independent. We all know that. That's why we're traders to start off with. Once you understand how to do this, you can be financially independent for life. Now, one of the pleasures, one of the great enjoyments that I have with this strategy is getting to know people all over the country that are trading it. And I'll just tell you, who I typically run into that is trading this strategy. And, anybody can do it. A high school person could do it. Lots of gals, can do it. I mean, anybody from any walk of life can do it. I'm just saying, this is what I typically run into. I run into retired gentlemen. They're a little older than I am, like a retired engineer or a chemist or an accountant, somebody that knows numbers and knows probabilities. And they're retired, they need something to keep their mind active, and they do this strategy, and they just bring in whonking amounts of money. And I've met these guys. They're all my heroes. I look up to all of them. I just think it's fantastic. I think if you're going to have a hobby, why not make a couple of bucks doing it? And one gentleman I met, really like him. He's I think he's down in Florida. And I talked to him on the phone, and he told me he made 28 trades in a row without a single loser. And I don't know where else you can do that. My cousin Ralph out in Chicago is a retired chemist, and he's really, really cute. I just absolutely love Ralph. He's really smart. And, he's been doing this for several years now. It's funny, his wife was skeptical about him trading options, and he says, honey, why don't I put an extra $1,000 in your purse per month? Would that be okay? And she's very skeptical, and she said, sure. Well, he started doing it, and she's not skeptical anymore. I mean, she kind of likes the idea. So, if you've ever gotten any flack for your trading, or if you've had a cold streak, or if you've had problems, I think you're going to like this. I think it's something kind of different. I think you'll really enjoy trading this way. So let's get to the meat and bones here. What is a credit spread, and how do we trade it? Let me explain what it is. Now, if you know this, it'll be a little bit of a review. If you don't know it, it might be kind of fascinating. So here we go. Here we see an index going up. This happens to be the SPY, represents the S&P 500. It could be anything. And there's a couple of different ways to trade it. Say you see it coming down here. Because of this big uptrend, because of this big uptrend support line, you feel like there's going to be a bounce. So here about, mid-April or so, you see this big green candle heading skyward there, and you think, you know what, this is what I've been looking for, I'm going to take a position. So there's two different ways you can do that. The traditional way is to buy the stock if you're a stock trader, or to buy a call if you're an options trader, because you're planning on that thing going up. There is a problem with that. I mean, I've made a lot of money on straight puts and calls, but if they reverse, you can lose money very quickly. Your timing has to be perfect. An awful lot of things have to line up for you to be right. So here's something a little more conservative. We get some distance. You'll notice right down here at this 154 level, we've got some support. And just under 154. That's a good floor. That tells us, this thing really doesn't want to go a whole lot lower than that. We've also got some uptrending support supporting this. If we were to have a bigger view of this chart, you'd see uptrending support going back several months. So we're going to distance ourselves from this trade. We're going to go a little bit lower. Now keep in mind, we'll be taking this trade just as you start to see it take off. So we're going to sell this 150 put. And at this particular time, when the stock was right in here, right about April 22nd or so, we could have gotten 72 cents for this. Now, that's great, but let me just tell you a little bit about your risk. If the stock suddenly goes down, that means somebody can put the stock to you for $150. Now, theoretically, and I'm just talking theoretically, this would never happen, but theoretically, if it went all the way down to zero, you've got risk from $150 all the way down to zero. Now, you don't want that kind of risk. The margin requirements are huge to maintain that kind of risk, and your broker doesn't want you to have that kind of risk. That's called selling an option naked. And I just want to tell you that you should never go naked down Wall Street. You might lose more than your dignity, and very few of us look good enough over the age of 30 to be walking around naked anyway, so don't sell options naked. It can be very, very risky and really tough on your brokerage account. So what do? What's the solution? Well, what we do is we buy another option to hedge, to protect ourselves. So in this case, we're going to go just $1 down. We're just going to go one strike down, and we're going to buy the 149 put for 57 cents. And that, because you can see that what we're selling for 72 cents actually is a larger amount of money than what we're buying, it creates a credit in our account. So let's take a look at what that might be. So we took in 72 cents. We subtract 57 cents. We have a net credit of 15 cents. And you can see this over on the right. Now, if you don't get too excited about 15 cents, don't worry. I don't either. So the neat thing about options is you just multiply them by the number of contracts. So you can turn that 15 cents into $150 pretty easily with the click of a mouse. You can turn it into from 150 to 1,500 to 15,000. So don't worry about the amount of money here. I just want you to get this concept, and as you start to understand it, it's a very exciting concept. Now, I just want to stop for a second and point something out to you. If you would have bought a call right up here when the stock was, around 155 or so, that's great. As you can see, the stock went up quite a bit, and you would have made money. But what happens if it would have reversed, as sometimes happens? What's really cool about this is with straight option buying and even stock buying, but with options in particular, not only do you have to be correct on direction, but you have to be correct on your timing, because all options expire at some point in time. So see this big vertical line that I have going right up and down here that's right about May 20th? Well, that's when this option expires. Now, this is one of the things I like about options. I used to really dread expiration dates when I was an options buyer, because I'll tell you, there's no quicker way to make time go by fast than buying an option. Because oftentimes that finish line starts looming large in the windshield and you are rushing towards it, and what is supposed to happen with the stock is not happening quick enough, and boom, before you know it, your option has expired worthless. And, that can be a pretty heartbreaking event for options buyers. However, for options sellers, it's an absolute boon. It's what we're looking for. Our object here, and if you just want to have one great takeaway from credit spreads, here's our object in doing this strategy. We want to sell things for a great value that later become worthless. Because once we hit this finish line right here, in this case on May 20th, that's where May's standard expiration is it's the third Friday of the month, so it's the 17th. And so I just have it actually at the beginning of the 20th here to show it on the chart. But it's the third, options expire on the third Friday of every month. That's the standard expiration. They've got weeklies now. So this one in May expires on the 17th. So what's cool about that is we have a finish line. We know we're not going to be in this trade forever. We know we're not going to sit around. I don't know if you've ever bought a stock and it went down on you and you said, I'm not going to sell this thing until it turns around. I'm just going to hold on until I get to break even or make my money back. Well, you might be sitting on that thing for a year, 2 years, 3 years, who knows? Well, with this, we've got a finish line. We know when we're going to be out of this trade no matter what. Now, the cool thing is when we sell an option, time decay gradually makes that worth less. And I'll explain more about that in detail later, and we can take advantage of that. But what we're doing right now is we've created a credit in our account of 15 cents. One of the cool things about this strategy is that money hits your account instantly. You can see it show up minus commissions. That's all you got to worry about. You see that show up in your account, and imagine if that was $15,000 instead of 15 cents. It can get pretty exciting, and you can create a really tremendous income. So if we get a 15-cent credit on a $1 spread, what is our return? What's our rate of return? So let's just get down to brass tacks here and see how much money we'll be making if this expires worthless. So this is how you calculate it. This is how you figure it out. So you have a $1 spread. So that is the distance between the strikes. You can do a $5 spread. You can do a $10 spread. You can do all kinds of width between strikes. That's between your two strike prices. In this case, we're doing a $1. So it's a $1 spread minus our 15-cent credit equals 85 cents. So 85 cents is actually our risk. That's the amount of money that we can lose. So if you're talking in terms of thousands, we have the opportunity to make $15,000. We could possibly, or $1,500 say, and we could possibly lose $8,500. So we go 15 divided by 85, our risk equals 17.6, or to round it up, an 18% return. Pretty darn good for just 4 weeks at a time, especially when you consider, in this particular case, with this particular trade, we had an 87% chance of winning. So I will take that all day long. We're talking about an 18% return for 4 weeks at a time, actually less than 4 weeks at a time, with an 87% chance of winning. Pretty cool. Pretty darn good. So where does this 87% probability come from? Well, what we are selling is time. If you'll notice, when those puts are out of the money like that, and we can do the same thing with calls, they have no intrinsic value. There is no value to those options. All there is time value. And the options pricing formula told us on this particular trade there was only a 13% chance of our sold option being overrun by expiration. That leaves us an 87% chance of winning on this trade. So this is just a really cool thing. When you get on any kind of trading platform, and I especially like Thinkorswim is a wonderful broker, and there's some other good ones out there, but they have a really, really nice platform. You can see what the delta is. You can calculate your probability of winning on a trade. And that's without taking in any consideration as far as which direction the market's going, what fundamentals are happening, whether or not we're in an earnings season, with none of those considerations, just the distance that you're selling away from the underlying, the volatility of the underlying, and the time we have until expiration will tell you your probability of winning. I really love the idea of going into every trade and knowing what my mathematical probability of winning is right when I'm walking in the door. I think that that's really cool. If you're trading between an 80 or 90% probability of winning, chances are at the end of the year you're going to be looking pretty good. So that's how that is calculated. Now, when you sell an option and it expires worthless, you get to keep all the money. That's pretty exciting. And once the option is expired, you have no further obligation. So instead of being worried and chewing our fingernails off as expiration approaches, like all the thousands of options buyers out there, we think it's great. You know, you get paid to take a nap. You get paid to sit by the pool. You get paid to go golfing. You know, most of us don't need a lot of lessons on procrastination. We can kind of hang around and watch time go by, or you know, conversely, actually, the truth is most of us are so darn busy, time goes by pretty fast without even doing anything else. And these expirations, they approach pretty quickly, especially when you're just selling a few weeks. So once these options expire worthless, at that point, you can go ahead and sell another option for the next month and collect another round of money. And as I'm going to show you here, you can just have money coming in virtually every Friday. I mean, every Friday starts turning into payday. This is a better time to do this strategy than ever before in history for a whole bunch of reasons. But one of them is a couple, 2-3 years ago, they came out with weekly options. And we can sell a weekly expiration several weeks away, and we started getting multiple paychecks per month instead of just one on the third Friday of the month. So that's just one of the enhancements we've seen in the last few years. This is getting really good. It's kind of a shame more people don't know about it, but I'm glad you're watching right now, because this is just really, really cool. So what happens? And I want to address risk right up front. You know, we need to address that. We need to get the boogeyman out of the closet and take a look. What happens if our sold strike is overrun? What is our risk in trading this way? So, you know, this isn't very likely to happen, but let's just say, you know, the SPY completely rolls over and just goes straight down and overruns both of these strike prices just kind of instantly. What happens to us? What goes on? If your entire spread is overrun, you lose the spread width minus your credit. In this case, that's $1 minus 15 equals 85 cents. So we could make 15 cents, but we could lose 85 cents. In other words, we could lose 5.7 times more than we can make. Now, if you're sitting here going, whoa, Nelly, that's really scary, I just want to let you know something. We are never going to let that happen. There's no reason to let that happen. It's not going to happen. You know, you're just not going to lose the maximum on a spread. The key is to close your spread early as soon as support or resistance is broken. So, you know, you're probably familiar with trading. You've seen support and resistance. That's one of the first things you learn as a trader. So you can see right here on this particular chart, you can see that we've got a pretty good support line here at around $154. Now we're way up here, getting close to 160 with the current price of this thing. If it were to suddenly drop and start following this arrow line down, don't you think that when this 154 floor is broken, somewhere in here, you should have some warning bells going on going, hey, you know what? This underline is approaching my sold strike. I think I'm going to close this position and remove all further risk. If you close it up here versus down here, it's going to cost you a lot less money. And if enough time decay is gone by, you might even make money on this thing. There's a lot of things we can do that are really, really cool. But one of the things that I just want you to understand right now that's really important is it's really important to manage your trades. And most of the time, you know, 80 to 90% of the time, we just have a worthless expiration. But maybe around 20% of the time, you might have to make a move or manage something. Now, I can show you how to actually set up orders to manage your trades automatically. And I think that's really cool, where you just set a trigger. And, you know, you say, man, 154, I'm starting to get nervous. At 153, I'm beyond nervous. I'm taking action. I want this thing closed. You can set an automatic trigger in there. Once it gets tripped, boom, this closes. You might lose a little bit of money. You might break even, but you're going to be so much better off. And then you can let the rest of your trades just do their thing and head towards a worthless expiration. So managing trades is important. Don't worry about the maximum risk, because the maximum risk isn't going to happen in 99.9% of the cases. So an 87% probability of winning is great. That's wonderful all by itself if we're just throwing darts and setting our spreads in the right place, you know, far enough away from the underline. But can we set up our trades so our odds are even better? Can we even do better? Is there certain things we can do? Now, here's a great example. What we're going to do here is acknowledge the direction of the market. So this whole thing seems to be going up. It came down when we decided to do this trade. It was coming down, sort of bottomed here in this 154 area in the middle of April. And then, we got the signal we were looking for. We see this big green candle going up and another one the next day, and we go, you know what, this thing's heading higher. The market's starting to take off. So we don't sell in the path of this stock. We don't get in the way of a moving freight train. We go down here way underneath it. We acknowledge, moving things around here. We acknowledge the direction of the market. We acknowledge which way this thing is going, and we sell underneath it. That's why we did a put spread here. We're selling puts. We're underneath it. We want to sell something that's going to expire worthless. If it was going down, we'd go up here, we'd go up above, and we'd sell a call spread. So the first thing that we're going to do, the first advantage that we're going to do to increase our odds is acknowledge the direction of the market. And you know what's cool is we don't have to be nearly as good as directional traders are. All we have to do is have it not turn around and head in our direction at top speed. I like to tell people this with credit spreads, and I think this is a really, really cool concept to keep in mind. A stock can only do 5 things. 5 things only. It can, in this case, it can go up a lot. It can go up a little bit. It can go sideways. It can go down a little bit. It can go down a lot. Now you think about this, where it is now, and look at where our spread is down below. If the stock goes up a lot, we'll make our full profit. If it goes up a little bit, we'll make our full profit. If it goes sideways, if we're totally wrong on direction and the thing just flounders around and flattens out for the next few weeks, we make our full profit. If it goes down a little bit, and it can go down, actually in this case it can go down quite a bit, but if it goes down a little bit, we make our full profit. There's only one out of those 5 scenarios where we can actually be threatened or lose any money, and that's if it goes down a lot. So you think about that. That's almost the exact opposite of a straight call or put buyer, where they need one out of those 5 scenarios to happen in order for them to make money. If you just kind of keep that basic concept in mind, you'll see why this is such an advantageous way to trade and why it's actually sort of a relaxing way to trade. So we're trying to improve the strategy, so what else can we do? Well, once the stock has gone up to a certain point, if we see any signs of a reversal here, so we're starting to see it kind of roll over. That's what stocks do. They go up and down. Very, very typical. Once we see it kind of roll over, and we've already got a put spread in place, we can go up and sell another spread in the opposite direction. So our first spread we got 15 cents for. And in this case, we're going to put on another spread. We're going to sell the 162 calls right up on top here, and we're going to buy the 163 calls. The 162s are we can get 44 cents for. We're going to have to pay 24 cents for the 163s. And we've created a new credit in our account of 20 cents. But here's what's exciting about this. Here's what's cool. If you do the same expiration date and the same underline, in this case, the SPY, your broker realizes, they understand, and this is another thing that's happened in the past few years. They used to make you hold both sides of the margin, but in the past few years, the brokers have gotten a little more sophisticated, and they realize that under no circumstances can you lose on both of these spreads at the same time. The underline can't close above 162 and below 150 at the same time. So they only make you hold margin on one wing or one of these spreads, but not both of them. So let's take a look at what this does to our rate of return. So we now have a combined credit of, we got 15 down here, we got 20 up here, we have a combined credit of 35 cents. So this is one of the really cool things about this strategy is the more money you take in other words, the more money you stand to make, the less your risk. That's usually the exact opposite of every other strategy out there. So we now have a combined credit of 35 cents, but our potential risk is only 65 cents because we still have just $1. We just have $1 at risk here. It can't close above and below both. So even though we have 2 spreads, We just have $1 of risk. So $1 minus 35 cents is what we've taken in is 65. So we only have 65 cents of risk for a potential profit of 35 divided now by 65 equals a whopping 54% return. So when we put on this other spread, the one on top here, we went from a potential return of 18% to a return of 54%. We more than doubled it because in addition to taking in more money, we simultaneously reduced our risk. And this is such an exciting strategy. Now, a lot of people, they call this an iron condor, when you have two credit spreads going on at the same time with the same expiration, a call spread and a put spread. And a lot of people put on iron condors all at the same time, and you can do that. There's perhaps times when that's advantageous to do. I like to put them on individually. So when the stock's down low here and the credit's real good for a put spread, but it's starting to reverse, we'll put on a put spread. When it comes up here, starts to reverse, starts to turn around, we'll put on a call spread. So we do these selectively when the timing is right, and you can really improve your odds. You can actually widen your spread out quite a bit, your distance between spreads, your wingspan, if you want to call it that, by doing it this way. So, why do they call it, this is called an iron condor? Because of the wide wings. See how far apart our wings here? Each one of these spreads is called a wing, and it's the wide wings created by your two spreads. There's another reason why they call it an iron condor, and that is because of the risk profile. So I just pulled this off of Thinkorswim right here, and this is the risk profile, and here it is. You see this kind of red line going right along here, and that's our maximum profit. Well, look at the wide range the stock can move for the maximum profit on this trade. And the SPY has already moved between, back and forth here, and I'm sure it will continue to until expiration. But there's this really wide range the stock can move for the maximum profit on this trade. Similar to horseshoes and hand grenades, getting close is close enough. So, we have such a broad range we can make money on this thing. We don't have to have the stock go to an exact target point in order for us to make money. The thing can zig, it can zag, it can jump around, it can drop, it can pop, it can dance all over the place. And as long as it stays between 150 and 162, we're going to make our maximum profit on this trade. That's pretty cool. There's a lot of peace of mind that comes with that. Okay, so what else can we do to improve this strategy? There's 7 main strategies to improve your returns and lower your risk in trading credit spreads. We're going to go over these fairly quickly. First of all, trade the right asset. Trade the right underlying. One of the big secrets of this strategy is to avoid unexpected volatility. You don't want that stock to suddenly fall out of bed and drop through your strike price. That's why we generally want to trade indices and ETFs instead of individual stocks. You want to spread that risk. Sometimes a piece of bad news comes out on a stock or, a piece of good news, and the stock just takes off like a scalded rocket. You can't, there's all kinds of stuff. There's all kinds of news releases. We're right in the middle of earnings season right now. Sometimes, something will come out and, the traders don't like it, investors don't like it, and the stock will just drop huge. Sometimes it's not earnings season. Does anybody remember Netflix? When Netflix came out and said that they're going to raise the price and that their subscribers got all mad and they started, dropping out of the service in droves. I don't know if you remember this, but when that happened, Netflix gapped down and the stock dropped $75 in just 4 days. You do not want to have a put spread on Netflix when that happens. Otherwise you might have an expression on your face kind of similar to this gal here, which I get a huge kick out of. She just looks like she's seen something totally shocking. And I think this chart right here falls into that category, especially if you own Netflix or had a put spread. We do not need this kind of volatility. We don't need that kind of action in our lives. We want calm. We want nice, peaceful, profitable expirations. So number 2, the asset must be efficiently priced. This is so critically important with options. So the best underlying assets have penny-priced options and narrow bid-ask spreads. Here's what I mean by that. The bid-ask spread can kill you as an options trader if you're not trading something that's efficient. So here's the bid-ask spread is 44 by 46. The bid-ask spread on this is the SPY once again, and there's others. There's other good ones. The bid-ask spread on this is 2 cents. That's nothing. In the heat of the trading day, I've often seen it go down to 1 cent. Down here on the bottom on the 163s, or that's the 162s, on the 163s, it's 3 cents. That'll narrow up during the trading day. Narrow bid-ask spreads are really, really cool. They're really important because we're putting on multiple legs. We're buying and selling. Sometimes you have to get out, and you don't want to pay a lot of money to the market maker to get out of something. I've seen in the old days when I used to trade options, and you can still find this on narrowly traded stocks that don't have a lot of options on them. You might see the bid at 50 cents and the ask at $1. I mean, the thing has to double in order for you to break even. That's not a good scenario. So you want these really narrow bid-ask spreads. Super, super important. I will not trade credit spreads on anything that does not have them, and I recommend you do the same. The other thing is penny pricing. So you see these are 44 cents, 24 cents, 72 cents. Once again, in the old days, options, and when I say the old days, I mean just a few years ago, and you still see some of it today on some stocks with their options, is where it's instead of a penny wide, there may be 5 cents, 10 cents, and they price their options that way. That's too much slippage in there. You're giving up too much to the market maker. We want to give up the very, very smallest amount possible. Those extra pennies on these spreads, as you can see, they make a huge difference. We want every one of those in our trading accounts we can get. So this is huge. The best underlying assets have penny-priced options and narrow bid-ask spreads. Do not trade on anything that doesn't have that. I've got a really nice list of great things to trade. You don't need a lot of underlines to make a fortune with this strategy. Just a few really good ones. So number 3, sell the right width of spread. So that means like we just did a $1 spread, and you can do, a lot of people do $5 spreads, some people do $20 spreads, some people do even wider than that. If you study risk versus reward, you'll find the more narrow the spread, the lower the risk, and here's the kicker, and the greater the return. So let me just give you a quick example here. So what we showed in our previous example is the 162-163 call spread. So if you look down here, you'll see the difference between those two is 44 and 24. So that's 20 cents. So on a $1 spread, that leaves you an 80-cent margin, or 80-cent risk. 20 cents divided by 80 cents is a 25% return. Pretty dang sweet for something that you have over an 80% probability of winning on. Okay, but if you want to widen your spread and you go, say, 3 strikes, you go the 162, 165. Let's just take a look here. The 162 is 44 cents. The 165 is 8 cents. So 8 from 44 is 36. But your margin is huge because you add $3 of margin. You subtract 36 cents. That leaves you $2.64 in margin. 36 divided by 264 is just a paltry 14% return versus 25%. I'll take the 25%, and we do that by narrowing up our bid-ask spreads. And I've written a lot of information about that. I've investigated a lot of different scenarios. I think if you're interested in this strategy, I think you'll find that information fascinating. But I want to just expose you to it right here. And this is a little bit different than the way most people trade these. On the other hand, we make a lot more money than most do that trade this. So here's number 4. Diversify your risk with multiple spreads over multiple time frames. I've heard traders say fly a flock of condors instead of just one condor. And we can do that with the help of weekly expirations. So, every week we put on a couple of trades, and we have different expirations for those. And what you start finding is you start getting paydays just about every Friday. It's pretty cool. It's pretty exciting. But aside from that, you're really spreading out your risk. So all your condors are at different strike prices. Some are above, some are below. You set them at different prices. And yeah, the underlying might bounce around and maybe threaten one of your condors where you have to close it early. But hey, if you've got 5, 6, 7, 8 other condors that are open and they're not threatened, you're going to have a profitable month. So this is another way of saying just don't put all your eggs in one basket and try and make it on one big trade every month. Spread it out a little bit, fly a flock of condors. With the automatic closing orders, it's really not that much to manage. So it's not tough, but you're really diversifying your risk. So that's number 4. Number 5 is get exceptional yield with leveraged ETFs. Now, we don't do this all the time. When things are getting kind of volatile, you want to stay away from the leveraged ETFs. But leveraged ETFs can offer incredible premiums for relatively short periods of time. Some of my favorites are, if you want to take notes, is the FAS, the FAS, that's the Financial 3 Times ETF. The TNA, that's the leveraged Russell 2000, and the TBT, which is the leveraged 20-year bond. So, we watch those bond prices go up and down in relation to the stock market. That can be a good one, too. They offer some pretty incredible returns. In just a little while ago, the FAS did either a 3-for-1 or a 4-for-1 reverse stock split to get the price back up there. But when it was up a little bit higher, there was enough premium that we could actually sell a credit spread, and in some cases a condor, on Friday morning of expiration, get a 20, 25% return, and just watch the time value trickle away with every hour. And by expiration, we'd made 20% on the day. Pretty dang fun. And you can't do that outside of these leveraged instruments. So once again, we use them really selectively. We don't use them all the time, but boy, when the time looks right, you can make an awful lot of money in a short period of time with a very high probability of return with these leveraged ETFs. Okay, number 6, sell on the steepest part of the time decay curve. The faster an option loses value, the faster we are making money as our risk evaporates. So here's a good example of a time decay curve. So you see here, probably all the way the entire horizontal distance here is 120 days. This marks 90 days, then 60 days, 30 days, and then finally 0 at expiration. So you can see how the time decay curve is fairly flat up at the top here. And then it starts getting steeper and steeper and steeper. I typically sell with just 30 days out. Sometimes 3 weeks, sometimes even 2 weeks. And occasionally we'll do maybe 5 weeks, but not too often. It's almost always within this last month. The reason we do that is because when all you're selling is time value, that time depreciates faster and faster the closer you get to expiration. The time decay curve, as you can see here, actually steepens. So the faster an option loses value, the faster we're making money as our risk evaporates. If you really want to eliminate your risk, you let that option, maybe you sold it for, have a credit of whatever, 15, 20 cents. You get down where that credit is only worth maybe, that option's only worth maybe a penny or two. Just go ahead and close it out and remove all your risk even before expiration. It's a really nice way to go. And selling on the steepest part of the time decay curve is a really good way to do that. Number 7, use automatic orders to manage your positions. And this is so cool. It is amazing what some of these brokers have come up with to automatically set up your trades. So when a certain trigger is hit, it's automatically closed, or perhaps a sold strike is bought back and you let your bought strike run. And you're not even aware of it. You're out enjoying yourself. Either you're working at your job, or you're spending time with your family, or you're up in the mountains hiking. You're out on the lake in the summertime. Whatever it is you're doing, you're not sitting there strapped to your computer monitor watching the market tick up and down. It's so wonderful to enjoy the peace of mind in knowing your spreads will be managed correctly, whether you have time to watch the markets or not. So these are the 7 biggies, and there's a lot of little things that we do to increase our odds of winning as well. We've had really good luck with this strategy, and probably a really good question to be asking right now is, okay, that sounds good. You've talked about different rates of return and this and that, but in the real world, what can I stand to make? What can you expect to make trading this strategy? Now, the standard rate of return you see advertised with most credit spreads and credit spread services is 5% per month. That's a really nice conservative rate of return. If you want to think of it this way, think of this as an income strategy. So a lot of people invest in dividend stocks. They do a lot of things to bring in passive income. And they're very, very fortunate right now if they can get 5% per year. I think Treasury bills pay 2% per year. The average dividend of the S&P 500 is somewhere around 2%, and it's been 2% for about 4 years now. So when you're talking about 5% per month, that's pretty huge for an income strategy. However, we typically bring in 15 to 25% per spread. I don't even like to do spreads for less than about 15. But as traders, we know we have to allocate for losses. So so we need to keep it conservative. So even though we bring in substantially greater amounts of money than 5%, occasionally you're going to have to buy back a sold strike. You're going to have to close something and roll it out, and that's going to take a little bit of your profit away. So, but we still do better than 5% most months, and most months we do substantially better. And we've got our track record that you can take a look at that we publish on the site. But just to keep it conservative, let's talk about 5% per month. And if you're an active trader that really likes to speculate, maybe that's not getting you too excited right now, but imagine if you're speculating with, say, 10 or 20% of your account, and you had 80% of it just sort of passively bringing in 5% per month with these trades set up with automatic orders. So if you got 5% per month, and if we just stick to that, that comes to an incredible 60% per year, non-compounded. If you compounded it, it would be even greater. So that rate of return can add up very quickly, and I just put this little graph together. If you can get 5% per year on a passive investment, that's really good. But in 5 years, that's not a lot. Your $10,000, say if you invested $10,000 at year 0, at 5% per year, it turns into $12,763. At 5% per month, there's a little bit of a difference here. You've got $186,792. But if you're thinking about income, and if you're thinking about having enough money to retire on and really doing something to boost your monthly income so maybe you can wave goodbye to your job, or if you are retired, have a lot more comfortable retirement, let's think about it another way. Not the amount of money that you have, but what kind of income that money's throwing off. So your monthly income at $187,000 is at just 5% is between $9,000 and $10,000 a month. And most of us can get along on that if we keep our trips to Starbucks to a minimum. Obviously, this is the real world. This is just an example right here. In the real world, we sometimes do better than 5%. Sometimes we do worse. It is actually, as good as this strategy is, it's actually possible to have a losing month. But if we just use this 5% per month average, you're going to be looking really, really good in just a few years' time. And that's starting with just 10,000. If you have more, obviously, you can do better. So let's just take a look at the takeaway of this strategy. Once you sell a spread, it just generally loses time value every day. And in most cases, it just expires worthless, and you get to keep all the money. But if the spread does become threatened, you can close it early. So you can close the spread manually, but once again, I'll show you how to set automatic closing orders ready to kick in if the stock hits a certain price, so you don't even really have to watch it. The way these trades are set up, you'll win most of the time. And when something is closed, it can be done automatically. And that is very, very cool. If this is a little new to you and you're having a little trouble understanding everything, don't worry. I've created a program that explains exactly what to do, why to do it, and how. And, of course, you probably figured that there was some education behind this, and that's a good thing. An educated trader can be a wealthy trader and a happy trader. So you'll see how, in this package I put together, you'll see how wide of a spread to sell, how much time to sell, what to do if the stock starts getting close to your spread, how many spreads to have on at one time, everything you need to give you the confidence to start generating consistent monthly income. And I have a feeling that if you do this, if you put on one spread, even if you do it in a virtual trading account and you're not using real money, once you see how this works and get a grasp on it and understand it, I think you're going to come to love it as much as I do. And as much as all these wonderful old retired guys all over the country are buying themselves new cars and taking vacations with the money they make from the spread trading. So I think you're going to love this. I really, really want you to check it out. So I've put together this really cool package. It's called The Winning Secret. And this says Stack the Deck on Every Trade. I've changed that to More Income More Often since the weeklies came along. because we really are generating a lot more money a lot more frequently. And let me just tell you real quickly everything that's in the package so you kind of know what you're going to be getting. You get a 140-page downloadable e-manual complete with color graphs, charts, pictures, everything you need to start trading profitably and stay that way. And I've got people that I turned this on to in live events 5, 6, 7 years ago that are still trading it, absolutely love it, stay in touch with me. And that's really gratifying to see it benefiting people. Plus, you get a 15-chapter video series where you can hear and see exactly what to do to start generating income. And that you can watch these right on your computer. I'll give you lifetime access to the site. You can get in there and watch these videos. Plus, you'll get 14 separate audio files that have been recorded just for audio. So you can download and listen to them in your car, on your iPod, when you're walking, when you're at the gym. So you can learn wherever you're at. So that's 14 completely separate audio files. You'll also gain access to our archived webinars so you can discover new strategies and ways to improve your returns and limit your risk. Just finished a fantastic one, really good webinar, a lot of really great advanced information on trading credit spreads. We just posted it in there this week, so you can get in there and take a look at that. And you'll also have access to all new webinars for life as an owner of this package. So this is lifetime access. It's a one-time fee. You'll never need to pay any more than that. And let me show you some other things that are included with this training package. The automatic money machine. These are 3 videos that show you how to set up automatic orders with our favorite broker to spread trade with. And these are the videos that show you how to automate your trades so you don't have to constantly monitor them, providing peace of mind for people with busy lives, knowing you'll get out of a trade if you need to at the exact right time without having to watch your positions. And I love this about this strategy is these automatic orders have made this, it really made a great strategy even better. I love not having to monitor things. And then special situations. Now, I sometimes find a trade setup that's so good it's presented as a special situation. Now, these are trades that bring in much higher returns and have really high odds of success. So we have to do them. They're rare and fleeting. I don't offer them all the time. Might be very infrequent. It's just when something really comes to my attention. So there's no guarantee of when they'll be presented, but when they are, they've proven to be very profitable. And this is just one more benefit you get with this package. So that's the package. On live events, I've spoken all over the world on this. I've spoken on cruise ships in the Mediterranean, been at resorts down in Mexico. I've been at a Whistler up in Vancouver, up in Canada, spoke all over the United States. And typically what we've sold this package for is $995. People are delighted to get it at that price. I've still got a lot of people that have bought it for that and are still getting back to me with their success stories, and I really appreciate that. On the website, we made it a lot more accessible. I think there's something about a live event when you're actually working with people one-on-one and talking to them that has more value for people. So on the website, we have it at $395, and we sell these every week, and people have great success with them at that price, and we just love our students and our subscribers. I'm going to do something really, really special for you. It's going to be a lot less than $395, and it's going to be a deal that you just absolutely cannot. I don't think you're going to want to refuse. I think you're going to want to get this. And I'm going to throw in something else really, really cool to spice the pot up here. I'm going to give you also access. I'm going to give you a start to our subscription service. This is where I come up with 2 new high probability trades every week, and they come out on Tuesday evening. And in addition to the package, I want to be there with you every week trading the strategy together. This is what I do in my Roth IRA. I love the idea of building up huge returns in a really big account, and the government can't touch the proceeds. Really, really cool. I'll show you exactly where to sell your spreads, exactly how to sell them for the greatest possibility of maximum gains with minimum risk. So I put together a special introductory package that includes the entire educational program, plus a subscription to The Winning Secret, and that's at, this is a really easy URL to type in. It's at spreadprofits.com. I think you're going to love it. The subscription is $97 a month, all by itself. The package is normally $395. You got to go here. You got to at least go here and look at it. And my gals put a price on that today. I'm not quite sure what it is. I would like to say the price, but I can't because I know it's great. I know it's killer. If you want to keep the subscription, you can keep it after the first month and keep trading together. I think you're going to love this. I think we're going to be together for a really, really long time. Don't pass up this education. It's just too good of a deal. So there's a URL down here. You can also, if Stephen, if your folks could please just copy this URL and put it in there. Part of it is Go Bigelow here, webinar special. And you could put it in the chat. Then people can actually just click on that and go right there without having to type anything into their browser. So let's just leave the screen here. Go ahead and put that URL down below into the chat room so people can click on it to make it clickable. If you don't want to do that, just go ahead and enter spreadprofits.com in your browser. Hopefully you'll see the deal that we're offering. Once again, $395 package, $97 a month subscription. I bundled them together, and it's going to be something that you really, really like, that you're not going to want to leave here without. So let's get to some questions and answers. I'd like to answer any questions anybody might have. Stephen, do you want to go ahead and take some of the questions and ask me, and we can get those answered? Stephen, are you there?
Yes. So I'm able to see the chat where Peter can't. So if you've got questions, I will just repeat them to him. Any questions? The price is $100 for the package and $97 a month. Is that?
I think they're bundled together. I think it's. Is that what you're seeing? I thought we were going to do it for $297. If you're seeing $197, we'll just go ahead and do that. We'll never sell it for that again. We never have before. That is a ridiculously good price. But
okay.
Let's do that.
All right. Do you ever adjust spreads to make them wider at one end or the other? And does this work?
Yes, we do. That's a great question, and I just didn't have time to get into that. I was going as fast as I could. Adjustments are a whole different, it's a whole subject. And, yeah, we adjust spreads all the time. We roll out of them, we roll up, we roll down, we roll out for more time. And you can also, what I love about this strategy is that literally, to pardon the cliche, it gives you options. So if a spread becomes threatened, you don't have to just close it and take a loss. You can close it and roll out or up, bring in more credit, and really preserve a profitable situation. So, yeah, we do that all the time. Absolutely. Good question. Anything else?
Okay.
If we don't have any questions, I'll just assume that it was so clear everybody understood how to do it.
No, we still got questions. I'm reading which one. Some people are saying it says $1.97 every month, question mark. Can you get the package without them? Go ahead.
You can get the package without the subscription. The package is $395. The subscription is $97 a month. I bundled them together just for this webinar. You will not see this anywhere else ever. I bundled them together for $197. Now what happens is you pay that one time, and then the next month the subscription is $97 a month, but you can get it for substantially cheaper than that if you want to get 3 months at a time or a year at a time. The reason we have a monthly available is for people that just want to try it. They want to check it out and see if it's right for them. What I can tell you is the profit that you make on one spread trade will pay for a year of the subscription, and you can carry on. I've always felt that these things should be self-liquidating. Your financial education should pay for itself. So go ahead, Stephen.
All right. Is the iron condor on the let's see, I guess the RUT was that the Russell 2000 a good spread?
Well, what we were showing in the charts was the SPY. If the question is the Russell 2000 a good underlying to write spreads on, it's fantastic. I've got a really big spread on the RUT right now. The RUT's great. Obviously, we're not going to do $1 spreads on that, but you do $5 spreads, and that's a very narrow spread for the RUT, because the RUT's expensive. So, yeah, that's a great underlying. I also like the SPX, which is the S&P 500.
Okay. Why did you use bid price for both sell and buy of the spread?
That's a great question. Most people think that they can't get that. You can. And I'll tell you what, it really, really depends on your broker. And I've got options accounts at a bunch of different brokers, and here's kind of the way this game works out there right now, is a broker will advertise some really, really low commissions, and since people are so commission oriented, they just bite on that, and I've done the same thing. And you get in there and you find out that their executions are terrible, and you can't get bid. So after trying a lot of different brokers, I went back to Thinkorswim. Those guys have the reason I like them, they don't just have a good trading platform, they have the best executions in the business. And what that means is you can get filled on these condors and these credit spreads almost always at the bid. I don't know how many other brokers you can do that with. And when we're talking about pennies on your spread, it makes a huge difference. It'll just obliterate anything you pay in commissions. So that's why I show that, because that's what I'm actually getting out there. And not many, if you talk to people, not very many people get the bid, but we do.
Okay, and what's a reasonable minimum account size to be really deploy the strategy profitably? Also, is there a broker that you'd recommend based upon commission / slippage / platform and data feeds to actually make money on a reasonable minimum account size? I'm chopping.
Yeah, those are all actually great questions. I would say you could start trading this with as little as $2,000. That's kind of skimpy. You're going to be doing, really small numbers of contracts, and you might get a little frustrated, but you could do it. If you have $5,000, and I think you can put $5,000 into a Roth per year. I think if you're over the age of 50, you can put in like $6,000 into a Roth, and that's actually plenty of money to trade this strategy and get your feet wet. Gosh, I opened a new Roth last year to try out a new broker. I think it was Trade Monster I tried, and I put in $6,000 into the Roth in like October, just exclusively trading this strategy, and it was up to over $10,000 by December. So you can do pretty well with a small amount of money, and then the thing feeds on itself. Then the next year you can put in the maximum again. It truly is for people that are a little concerned about retirement or how they're going to do that. If you're conservative on this strategy and you don't get overly greedy and you're smart about it, I can't think of a better way to bring in income unrelated to a job. And you asked a little bit about brokers, and once again, with a small account, I would go with Thinkorswim because they get such good executions. They have an incredibly good platform. Their commissions are reasonable. I wouldn't call them super cheap in today's context, but they're not expensive either. They're not bad. So yeah, I think that's a good broker to take a look at. What else?
All right, another question: is the system auto traded at any broker?
I don't auto trade, and here's the reason I don't. Because I think it's really, really important for people to learn this on their own. If I get hit by a truck tomorrow and you've been making your living with this strategy for the last couple of years, I don't want you to suddenly not know what to do because, we're not auto trading it. So that's just philosophically something that I've never thought was a good idea for people. If you want somebody to manage your money, there's lots of funds and things that you can put it in, but we just don't do that. I really believe in education, and that's really come back. I've gotten a lot of wonderful, letters and emails from subscribers saying, "Boy, this is just working out great," and I think it's because they know how to do it and they have the confidence to. So that's why the education is important.
All right, another question. I've never traded options. Do you think the package has enough educational material that help to start trading options?
Yeah, that's a great question. It's not really an intro to options package. but fortunately, I mean, you can buy relatively inexpensive books on just, or even go on the internet and get a little introduction to options. And I think we'll because of that, there is that demand there. I think we'll be putting together an inexpensive package that just, tells people about options from the very beginning. If you were to spend just a tiny amount of time, just a few hours understanding, what a put and call is and kind of basically how they work, you could get this package, and I think you could. I don't believe in writing in a big complicated fashion. I believe in putting it down there in just language you'd talk to your buddy in over the kitchen table if you're trying to show them something really cool that you were doing. And I don't use a lot of big words. I don't use a lot of math. I mean, I just explain basically how the thing works and what you can do to really help yourself and improve things. So I think with just a tiny amount of options introduction, I think you could understand the package no problem.
All right. Do you calculate the winning probability percentage as the difference in the delta of the sell option and the delta of the buy option? I got to figure out what that question asks.
Well, no, I know what they're asking, and
okay.
That's kind of an easy, dirty way to do it is look at the deltas. And so, for example, if you're taking in, on the delta, I'll tell you that the correct way to do it is, once again, Thinkorswim has a really good platform, and I just go to their probability analysis, and I plug in the parameters, and it tells you what your probability of winning is, and that's what I go based on. But their question's a good one because you can use the delta. Yeah. If you're selling a 25 delta, you got a 75% chance of winning. If you're selling a lot of guys won't sell more than a 10 delta because they want that 90% chance of winning. And I don't blame them. For a lot of older guys that are retired, that's exactly the way to go. So that's a good question. I use actual probabilities from Thinkorswim, but, you can use the delta too.
What day do you put the weekly spreads? What day do you put on the weekly spreads?
So there's a little bit of misconception on this. A lot of people, when they think of trading the weeklies, they think, the weekly just becomes available on that previous Friday, and you can trade it that previous Friday or the Monday or the Tuesday, and the thing's going to expire on Friday. I don't typically do that. That's really, kind of speculative. I think there's a place for that kind of trading. I really like to keep those odds stacked in our favor because I don't like to have winning trades or losing trades because the subscribers kind of get mad at me when I do that, and they won't let you get away with that too much. So on certain underlines, not all of them, but on certain of them, like a good example is the SPX or the RUT. They've got multiple weekly expirations that you can get into 2 and 3 weeks out. So it used to be when the weeklies first came out, they only became available on like that Thursday evening or that Friday morning. So you had a week before they expired. That was the only time you could get in on. But now you can go 2 weeks out, you can go 3 weeks out, so you can really space out your paydays. And we just did a spread this last Tuesday or Wednesday morning on the SPX, and we couldn't get quite enough premium on it with the usual May expiration. So I just went one week further out. So instead of expiring May 17th, it's expiring May 24th, and we got the credit that we were looking for. And that's gonna return us 25% if it expires worthless, and I think it probably will. So. We don't do the real short term, usually, the 3-4 day kind of stuff. I know others do, but I like to really keep it conservative and keep people making money.
Okay, somebody's asking, do you do naked puts by themselves?
I don't, and I kind of made a little joke about that, about not wanting to go naked down Wall Street, and heaven knows that you'd be doing society a service by not doing that. I just don't sell naked. It's not interested in having the stock put to me. I'm not interested in having the really big margin requirements that selling naked puts entails. Selling a naked put, it has the same risk-reward profile as selling a covered call, and I'm not that excited about those either. I mean, we get far, far bigger rates of return, with, in my opinion, less risk by selling credit spreads. So no, we don't do. I think selling naked puts is an inferior strategy.
Okay. Do you cover calendars, rations, or butterflies?
Calendars, rations, and butterflies. Aren't options cool? I mean, they have the coolest names. I mean, it's just wild. I don't. I'll tell you, I first got retired back in the late 90s. First kind of little fortune I made in the markets was trading calendar spreads. And the market was going up at a, pretty steady clip there for the last half of the 90s. And, you could buy something with 2 years of time on it and just sell against it every single month. And it was just a really cool strategy. And that's kind of how we started out. And I just don't do that anymore because I consider the market a little bit more erratic. We've had some big downturns. And I just kind of want to sell that month in the opposite direction of where the market is going and just collect our money that way. Those are all good strategies. You can make money with those strategies, but we kind of pretty much stick to vertical credit spreads and combining two of those to create an iron condor when it's appropriate.
Okay, do you typically let spreads expire worthless or buy them back on expiration day? I guess.
Oh boy, that's an area where there's two different camps, and there's a lot of people that say, hey man, if it gets cheap enough, just buy it back on the spot. I'm a little bit of a skinflint, and I don't want to spend the commissions to do that, so if it's pretty far out of the money, I will just let them expire worthless. But I will tell you, there's one instance where you don't want to do that, and that is with the RUT and the SPX. They cease trading on a Thursday at the close, and then you get settled the next morning at the Friday's open. And I've just had too many experiences where that darn thing is gapped. So if you're anywhere close to the money in that kind of a situation, you absolutely close that spread before it expires. But an awful lot of the time, I have to admit, if it's way out of the money and there's just no way, I don't worry about it. I just let it fade quietly into the night and have a nice little celebration on Saturday.
Okay, I'm scrolling down here. A lot more questions about the package. Let's do this again. Peter, somebody's asking, please explain what you get with the subscription. Go through that again for everybody.
Yeah, okay, so what you get with this complete package that we're offering here tonight is you get the complete educational package, which is huge. And I'm combining that with a month subscription, and you get both of them for $197. And with the subscription, you get an update that comes out every Tuesday evening. I write that myself. It takes me kind of all day Tuesday to write it. It talks about market conditions, which way the market's going to go. It presents 2 new spread trades, gives you your entry, exits, exactly when to get in, when to get out, why we're using these spread trades, what we think is going to happen with them. And then I give follow-up with our existing spread trades, what we need to do, what we need to be concerned about, what we need to take a look at. A lot of the time we don't have to do anything. So it's a really comprehensive letter. And I've been publishing that for a while now. Really like the strategy. And then if there's something that comes along midweek or that's not a Tuesday evening that needs to be addressed, of course I'll send out an email. Usually that doesn't happen. Also, if there's opportunities, like when we used to do the FAS on Friday mornings before it did its reverse split, I'll send out an email on that, and and that wasn't an every time deal, but yeah, the subscription I keep pretty close touch with you. If there's something going on, I send you out an email, and you can depend on a complete follow-up and catch-up every Tuesday evening.
Okay, does your training package include how to do adjustments to the spreads?
Yes, it does. Very, very important. Okay. Once again, didn't have time to cover that here today. I think I probably went over time as it was, but yeah, that's all in the package.
Okay, I guess... I think a lot of these questions are redundant from what we've answered before. So with that, I'm going to say, Peter, thank you very much. This was very educational, very easy to understand, and hope we get some good reactions from all this.
I do too, Stephen, and once again, thank you for having me in your hallowed room here for webinars. I appreciate you having me as a guest, and it's a pleasure being associated with you and your company.
Oh, great. And you likewise. All right, everybody. Thank you for showing up. Peter, thank you. And we'll call it a night, and hopefully we'll see everybody in the chat rooms.
That sounds good.
Thanks.